Hello, my fellow investors, and welcome back to the viewer-requested fundamental analysis video. Today, guys, we're going to be taking a look at one of your recommendations, the last one that we got in the form of the company AKAM. This was brought up by Tony. So he recommended this company, probably because it's near 52-week lows. He usually does that. And seeing that we already did Fortinet, I figured, you know what, let's just do this one and be done with it. So that way you guys get tomorrow just the weekend deep dive. Now, I did get another comment asking for the company and you knew. However, I already did that as of May, so I'm not really going to redo it again. I did already respond to the person that commented, that I already did it and I gave the person the link. So I'm not going to cover that. So today we're going to cover the company Akamai, AKM. Again, brought by Tony. So let's take a look at this company, guys. But before we get started, make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. Make sure to follow us on XF Fatal Investing. And if you would like to join us on Discord, the link is in the description below. So with that said, let's get started with this analysis. So now let's take a look at the company profile. We got Akamai Technologies Inc. provides cloud computing, security, and content delivery services in the United States and internationally. The company offers cloud solutions to keep infrastructure, websites, applications, application programming interfaces, and users safe from various cyber attacks and online threats while enhancing performance. I think we can pretty much stop right there, guys. They are, once again, in the cybersecurity space, just like Fortinet is. Again, there's a lot of companies right now in this space. And it's a space that it's really high demand, right? The more we go into like more technological things, more companies are going to prop up where this is going to be much needed. So let's take a look at now, guys, their earnings. Now, let's just take a look at the earnings summary right here, and then we're going to take a look at their actual earnings, at least how Seeking Alpha summarizes it. So we get over here on May 9th, they did have earnings, EPS normalized actual, coming in at $1.64, beat by 3 cents. EPS gap actual $1.16, beats by, 16 cents, and revenue of $986.97 million, a miss by $2.18 million. Now, in the next earnings that we got over here on August 6th, we can see that the EPS normalized estimates coming in at $1.53, EPS gap estimate 94 cents, and the revenue, it is $977.58 million. 18 total revisions, all of them to the downside. Very, very interesting right there. Now, taking a look at their actual earnings summary, I guess you could say, we got over here non-GAAP EPS of $1.64. We already saw this, beat by 3 cents. Revenue of $986.97 million, misses by $2.18 million. The thing to know here is that even though the revenue did miss, guys, year over year is up almost 8%. $986.97 million is around 8% year over year in the positive. That's actually really good to see. So it missed on analyst estimates, but it did beat overall year over year. Security and compute revenue represented 64% of total revenue in the first quarter and combined grew 22% year over year, and when adjusted for foreign exchanges, US revenue was $512 million, up 8% year over year. International revenue was $475 million, up 7% year over year, and up 8% when adjusted for foreign exchange. And then adjusted EBITDA was $417 million, up 11% increase from the first quarter of 2023. And if we take a look at their overall outlook for Q2, revenue is expected to be $967 million to $986 million. The consensus being $1 billion. So yeah, they're still expecting it to be lower than the overall consensus, right? So we may get the company to fall even more, right? Non-GAAP net income per diluted share of $1.51 to $1.56 versus a consensus of $1.64. Again, more of a reason for the company to be falling more. And the reason why I'm saying that is because when this came out, guys, on May 9th, shares fell 7.29%. So let's come now into the calculator. We got the ticker for AKAM, market cap of $13.78 billion, a P of 22.53. So not exactly where I like it to be, around like the 20, but fairly close. Current share price of $90.47. If we take a look at this, this is actually incredible. So on the 1 year, they're up only 0.28%. Year to date, they're down 23.56%, guys. Absolutely crazy. If we take a look at this on the 1 year one more time, you can see that this thing was going up until essentially the beginning of this year, right? February 12th, 2024, reaching a peak of $128.15. In fact, the 52-week range is 129.17 and the low is 87.59. So again, Tony usually gives me near 52-week low companies, which I fairly enjoy. And you know, it's good companies to at least analyze to see if maybe they are a decent buy because they're that low, right? Not necessarily that they are a good buy right now, but it's a good stepping stone, I guess you could say. So yeah, this is massively down, absolutely massively down. Now, they don't pay out a dividend, which means all of the free cash flows going straight into themselves. And if we take a look at this, guys, the 10-year average free cash flow is $720.26 million, and their last year's free cash flow is $769.5 million. So this is pretty good to see, right? The increase. However, we need to see the overall trend. So let's take a look at these graphs right now. So let's start off with the net income. We got 10 years ago, and I don't even need to move my camera. We got 10 years ago of $333.9 million to 1 year ago of $547.6 million, increase of 64%. This is honestly a little bit difficult because you can see that this is not consistently increasing. However, overall, though, it is, right? Overall, it is. We can see here that, you know, they did go down. They were actually heading down from 10 to 7, but then from 7 all the way up to 3, they shot up massively. Then they fell back down as of 2 years ago, but now they're going back up again. So this is all over the place. I put this thing as an 80. I'm actually going to change this because I'm going to have to give this guys like a 70. It barely passes. It's heading in the right direction. It's just there isn't enough consistency for me to be like, oh yeah, it's like an 80 plus. It's a 70 is good enough though. I really wish it was better. Looking now into the free cash flow. The free cash flow is looking actually similar. I would actually argue it's even worse than that of the net income. I was not say similar, but it's actually a little bit worse. We got 10 years ago of $450.9 million to 1 year ago of $769.5 million, increase of 71% with an average, as we saw, of $720.26 million. Now, this is, okay, it's weird because it's like there isn't a pattern necessarily. On the short term, like if you take a look at this on like every 3 years, there really is no pattern. On the overall though, there is. However, it's very, very peculiar, right? You see instances of it going up, then it comes back down, then it goes back up, then it comes back down, then it shoots back up, and then it comes back down. So I look at this and I'm like, I'm going to say a 70% for this one. Maybe you guys could even argue a 60, 65, because it's like, yeah, it's very difficult to make heads or tail out of this. It really, really is. There really isn't a really good pattern at all here. Now, the revenue. Okay, the profit metrics, the two that we have just seen, kind of iffy. This is perfect. This right here, absolutely perfect. Guys, we got $1.96 billion 10 years ago to today of $3.8 billion. That's an increase of 94.1%. What's even better is the fact that all of these graphs hit that trend line every single time. You know, I love that. I love that because it shows perfect consistency. Meaning, when it comes to making the, when it comes to making the assumptions on the revenue side, that's such an easy thing to figure out because if they've done it before in the past, most likely they'll continue to do it in the future. That's why I'm going to give this a 100%. Really, really easy. Now, assets as a reference only, you guys can see that it is increasing. However, the same thing can be said for the liabilities. And the assets minus liabilities, you know what? It's actually fairly good, as you guys can see. Increasing with a little bit of a hiccups here and there, but overall, it's really, really good. Average total assets of $6.7 billion, liabilities of $2.9 billion, that difference of $3.81 billion, guys. That is an easy 95%. Now, the next one, it is the cash flow minus liabilities. Cash flow has been all over the place. Liabilities, though, consistently increasing, as it should, right? As you would expect. Yeah, this is very, very bad, right? This is very bad. Not consistently decreasing. I was about to say that. There's a few instances here of it actually going up, but the overall trend, though, it is to come down. As of 1 year ago, it is at negative $4.5 billion. The average, guys, is negative $1.9 billion. 10, 9, and 8 years ago, it was getting very, very close to zero. And then they just, boom, took on a ton of liabilities. And also, at around the same time, like the 8 year ago mark for the cash flow, well, the 8 and 7 year ago mark, you guys can see that it did come down a little bit. It did it did come down a little bit. So yeah, you guys can see that. I'm going to give this a 20% when it comes to this one. And now the shares outstanding. This is the one that a lot of people don't really tend to look at. I do though, because it is super, super important. This shows dilution. And we got 10 years ago of 178.3 million shares to today of 152.4 million shares. That's a decrease, guys, of 14.53%. Now, this is not a consistent decrease. It really, really isn't, right? It really, really isn't. However, when they do increase it, it's so tiny. And by the looks of it, guys, they increase it when they have to. For example, the one increase that we see here up until like 4 years ago, actually up until 3 years ago, was during COVID, right? 5 to 4 years ago, they increased it by 0.7 million shares, or actually, yeah, 0.7 million shares. So about 700,000 shares or so. That's nothing. That's nothing. And it was because of COVID. I'm not really going to blame them for this though. So that's what I'm saying. They buy back when they have to buy back, and they issue when they issue. That's why I'm going to give this 100%. I like it. I really, really do like it. And lastly, cash and equivalents. They currently hold $467.7 million to the average of $453.2 million. Overall grade, 78%. Yeah, I see it. The main issue I see with this, guys, is the profit metrics, especially the net income and the free cash flow. It's not consistent enough for me to actually like, oh, it's amazing. It could be better, but 70%, I find it fine. 78% total, though, it's okay, right? It's okay. The main issue now, it is valuation. Near 52-week lows, the PE is a little bit high. However, let's see what the discounted free cash flow actually says. So right off the bat, we can see here that not adjusting for debt, $137, guys, $137. And then adjusting for debt, it comes down to around $124.82. Now, let's input some of these numbers. For the share buyback, they guys, on average, though, they do a pretty good buyback. So I'm going to say 1% buyback, 2%, sorry, not 3, 2% buyback, and then 3% buyback in the next 10 years. I think that's very, very applicable. I really do think that that is very, very applicable, seeing that they've been doing 1.81% on average every single year in the past 10 years, right? So basically, they'll do 1%, 2%, and 3% every year in the next 10 years, right? So this is not 1% total in the next 10 years. This is 1% every year for the next 10 years. Now, in regards to the revenue, 7.14%, this is the average, right? Every year for the past 10 years. The thing is that they've been so consistent with this. I'm going to have to say, guys, for the median is an easy 7%. For the lowest, let's say 6%, right? And then for the highest, let's say 8%. I think these numbers are very, very close to reality and what they actually may do in the future. This is why I love companies that are consistent. The more consistent they are, the more, I guess, the more precise and the more certainty the discounted free cash flow actually has when it comes to predicting these values. So the required rate of return. This is an information technology company. I do not know if they are in the S&P 500. Let me just do a quick check on this. And yeah, they were added to the S&P 500, guys, as of 2007. It also just dawned on me that Tony usually gives me companies from FinViz, which is part of the S&P 500. So that kind of does make sense to that. So yeah, I don't think I need to check on that. If Tony recommends it and it's in the, if Tony recommends it, most likely it is in the S&P 500. So yeah, this is in the S&P 500, meaning it's, what I'm going to say, guys, it's an information technology company, cybersecurity. I don't know what else to say, but I'm going to have to do 15%, I would guess. 15% when it comes to the required rate of return. And we can see that this puts me at around $49.88 to $69.76, not adjusting for debt, and adjusting for debt, $36.47 to $53.32. Margin of safety of 5, 10, 15, $31 on the dot to $50.65. So as it currently stands right now, it's looking a little bit expensive based off of these numbers. Now, again, not financial advice. Every investment is the present value of all future cash flow, guys, right? Every investment is that. These calculators are available for free because at the end of the day, you may not want 15%, right? You may believe that these numbers are too low when it comes to the revenue. It's up to you to make that determination, not me, right? I these numbers that you guys are seeing here, this is not what the share price is going to. This is what the company should be valued at. It's two different things. It's absolutely two different things. So make that determination for yourself and see what numbers you get. Maybe you guys know something that I don't, right? I don't look into these companies any further than this. That's up to you guys to do, right? That's up for you guys to do. So that way you guys can make your own financial decision for yourselves. This just helps you gauge as to where this company should be valued at. Looking at this right here though, if it was up to me, I would actually begin buying it at this point. And here's the reason why. We're close enough to that high assumption that I would rather not, I guess you could say, miss out. That's like a bad phrase to say, but I would much rather buy now. And if it continues to go lower, dollar cost average, assuming that the fundamentals remain the same, right? You have earnings coming up. They're expecting it to be really, really bad. The revisions have been going down. So most likely the company will go down when earnings come out in August. Maybe. We'll see, right? We'll see. So if that were to happen and the fundamentals still remain the same, if you still have the same thesis, then dollar cost average down. That's just what I would do. But again, not financial advice. So all in all, thank you so much, Tony, for your recommendations. And guys, earnings season's about to start real soon, right? It starts Friday. So if you guys want your recommendations, your companies for me to look at, please do it before Friday, because I will probably not be able to get to them anymore now that earnings season's about to start, right? We like to look at earnings season, just focus on that. So Friday is when earnings season starts. So you guys have Monday through Thursday, essentially, Monday through Wednesday, to actually begin giving me more companies. Again, if you would like with me to analyze them. Now, something I want to mention as well is that this Friday, the 12th, we're going to have a live stream, obviously, covering the bank earnings. That's a guarantee. In addition to that, though, I am going to be taking part of a Mario Kart tournament only on Rumble. Okay, only on Rumble. So it's just something I like to do. I can't always just be doing this. I want to have fun. So I really do want to stream it, especially with Facecam now. So I'm going to be doing a Mario Kart tournament with a couple of the Rumble creators, the same people that I did it last time. So right after the stream, right after the normal stream, we'll cut it off on YouTube and then we'll continue it only on Rumble for the Mario Kart stream. So just letting you guys know that that is happening next Friday, the 12th. Thank you guys so much for watching. Make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. Make sure to follow us on the X at Fatal Investing. And if you'd like to join us on the Discord, the link is in the description below. It's free. So with that said, guys, peace out, and we'll see you all next time.